Hey everyone, I'm seeing attendees rolling in, so we'll give a few seconds for people to join in. Hope everyone's having a great morning if you're on the West Coast, or great afternoon on the East Coast where I am. Right. So hi everybody, I'm Shreyas Mecheri, Product Marketing Manager here at Jirav. And I'm very excited to bring to you our session today, which is raising capital in 2023. We all know there's rising interest rates, there's economic uncertainty. So we are very happy to bring to you two very unique perspectives on this, one from an investor and another one from our very own founder. Today, we are going to have Kevin Jacques, Cota Capital partner, and Martin Zych, who is our co-founder, joining us. Kevin is a partner at Cota Capital, but before that, he was vice president and head of corporate ventures at Visa, where he led the company's venture investment efforts and served as the lead partner for over 25 FinTech transactions. Before that, he was at Intuit for 7 years, where he led the corporate development and investments for Intuit. There he had over 30 acquisitions, 7 divestitures, 4 direct corporate venture investments, and a lot more, which I'm sure Kevin can tell us more about, with a total deal value approaching almost $2 billion. Hi, Kevin.
Hi, Shreyas.
Right. And Martin, who is coming fresh off our Series B, $20 million Series B, is the co-founder and CEO of Jirav. And Martin is a true finance and accounting professional through his career. Before Jirav, he was the finance director at multiple companies, and he has also built Jirav as the tool he wished he had when he was working in these jobs. Through Jirav and through his other roles, he has helped dozens of companies raise funding, and he has seen it himself. So he brings that founder perspective and also his perspective of helping other companies through their funding efforts. Hey, Martin.
Hey there.
Right. So before we dive in, real quick, some housekeeping items. You will see a Q&A box at the bottom of your Zoom link. That's where you can drop questions through the session. We'll answer some of them during the session, but most of them at the end. And this is going to be a really interactive session. We want to make it something that's a true discussion. And so there will be a recording that will be emailed to you at the end of the discussion. So, you know, there's not a lot of screenshots you need to take or anything like that. Just rest assured. Finally, because we want this to be engaging and tailored to what you are looking for, we'll have polls throughout the session asking you things like where you are on your fundraising journey. So we encourage you to participate in those polls so that we can make this as relevant as possible for you. So what will we learn today? At the end of this session, we really hope you walk away with these things. We hope you walk away with a solid understanding of, well, what are the basics when it comes to raising investment or raising debt from a lender? What do companies, investors, and financiers generally look for? We layer that with, okay, those are the basics. What's happening right now? What are the current trends in fundraising? And then finally, we'll end with all of these, the basics, what's happening on right now. How can you as a finance leader or an accounting firm advising your clients demonstrate financial health and position yourself for fundraising? So with that, we are going to kick off by getting to know more about you and understand, are you or companies you advise looking to raise capital in the next 12 months? So I'm about to launch our poll. Just a note that if you have 2 screens, sometimes it might go on your second screen. But our poll is up. And yeah, the answers are yes, planning to raise equity, planning to raise debt, maybe planning to raise both, or not raising capital right now. Panelists, what do you think we are going to see in responses? I'm going to leave this up for a few more seconds.
I don't know if I should bias the answers with what I think versus maybe pretending like I expected whatever it'll end up coming out once we see the results.
Okay, all right. I am going to close the poll and share the results. So we see that we have 40% not raising capital right now, but they are probably curious because they want to position themselves for it. 24% planning to raise equity, 28% planning to raise both equity and debt, and 7% planning to raise debt. That brings us to our, was that surprising to you all?
I just 60% planning to raise, one or the other or both. So most of the audience will be raising capital. Good to know.
All right. So with that, let's jump into the basics and try to get to, what are the evergreen basics we need to be aware of. So I'll start with you, Kevin. Can you tell us more about the companies you're on the board for and what they have been seeing in terms of fundraising trends lately?
Absolutely, Shreyas. I sit on 4 boards for Cota Capital, Jirav, another company called Token that is in the real-time or account-to-account payment space, Compliance AI that produces GRC software, and a company called Ether that makes software tools to enable frontline and field service workers. 2 of those companies have raised capital in the last 9 months. More broadly, Cota has almost 90 portfolio companies. Like every venture firm, we get together as a partnership on Mondays and spend the day talking about our portfolio companies. On any given month, we have probably 2 to 5 companies that are undergoing some form of capital raise. So lots of exposure to the market and the market trends, and particularly as the trends have shifted over the last 6 to 9 months.
Great. Well, I once heard you describe companies as either painkillers or vitamins for when it comes to how they stand out in the market. Can you describe that concept to us, please?
Sure. Well, first, maybe I'll say, why is that important? And for everyone in the audience that has been fundraising or even watching maybe the stock prices of recently IPO'd tech companies, it's become a much more challenging market to raise capital. Valuations are down. Valuations for a lot of newly public companies started to drop in the end of 2021. And in some sectors, it's continued straight through to the middle of 23. And that's caused investors to kind of move the goalposts and change how they think about allocating capital and what kind of milestones they want to see in companies. So in general, capital has become a lot more expensive. And for better or for worse, I have been a venture investor now for about 23 years. This is the 3rd venture cycle that I've been able to kind of watch from the inside of the industry. And when times get tough, people want to make sure that not only are they investing in fair valuations and good companies, but that the product is one that that it is a painkiller, not a vitamin. It's a must-have for the buyer and the end client. I think another way to think about it, maybe an even better description, would be, is it mission critical? Would it be just kind of nuts because you provide so much efficiency to the buyer, so much benefit, or maybe you're even baked into the product that they themselves deliver to their end customer? Do they even have the option of not buying or delaying the purchase of your product? And these days, people really want to make sure they're seeing things that are painkillers or mission critical, so that there's more predictability in the revenue stream of the company that you're investing into.
Thank you. Well, moving over to you, Martin. What was your reaction to the poll results we saw there?
I think it's exciting because you hear all this stuff in the news that venture capital is dwindling and availability is going down, but and then we all need to run our companies and we need to be able to be able to grow. So I think the group here is a lot of folks who hopefully are doing something right and building valuable companies right now, building these painkillers for folks, and we can help with chaos in the markets. There's always opportunity, and we can hopefully help some of you guys learn a little bit and be successful in your next round.
And speaking of rounds, you are just coming off a successful Series B, but you have also helped other companies raise capital. Do you find everyone always wants to know, right? Do you find there's a playbook that works across businesses, across different industries?
It's interesting. I think there's no one size fits all, but there are some common questions and things you have to do going into the process, and then also based off of like maybe the stage of round that you're doing. So like our Series B, this was my 17th time in my career raising venture capital, and so I've gotten to do seed, Series A, Series B kind of companies. It's not Jirav's 17th round, but I've gotten to do this several times. So I've learned a lot on what works, and I think the big ones are though. I'd say for words of advice for people going into things is, everyone has certain things they're looking for. And, it's when you're going out to market and you're going out to fundraising, it's almost kind of like you got to be able to make sure that you're the right fit for them. Almost kind of like dating, and you're doing this interview and it's, what age of company, you're looking for different characteristics for a company. It might be, how far into the business are you? Are you a Series A type of company with Series A stage metrics that a Series A investor should be looking at? Or are you talking to a VC who only does Series B and C deals, and they're just building pipeline, but they're not going to really do a deal with you in the next year? Should you be talking to that person or not? So I think the common things that I'd say are, always making sure you're looking at that right stage company. If you can vet this out as well, if you get a broad answer, ask them specifically, like, what scale of company do you typically invest in? And then from that, you can really quickly see, okay, am I at that revenue range that maybe someone would want? And you don't have to tell them your number, but all of a sudden from that, you can, deflect the conversation, or you can engage a little bit deeper in there. Ask them a little bit about, their fund size, how many deals do they do how many deals have you done in the last 12 months? What's your typical investment size? These are the kind of heuristics that really quickly you can start weeding out in the first 5 minutes of a conversation with someone. Should I dig in deeper or not? And you'll have to have a lot of at-bats as you go into one of these processes. So that's, I'd say, the very first kind of little nuggets of wisdom going into a fundraising process that I've seen so many people, take every meeting and chase down the wrong tree that way.
Thank you. So
Martin, I think your advice of do your homework on the investors is spot on. And I could be biased since we led your last round, but I thought you did a great job of kind of doing the homework on who had that appetite for the stage you were at, who had experience in your industry. And, by the way, everyone should want investors that offer more than capital. And I think you're a lot more likely to get that if you do your homework and find people that really know your market, your channels, and the type of product that you're selling to your customers.
Yeah, that's another key one. Yeah, for word advice is like, you could be talking to a firm, but even, make sure you're talking to the right person at the firm. That's a really key thing, because the logo may look awesome, but you might actually need to be just working with a colleague of that person, and do your diligence, before going into that meeting, and see, what did they. There's always on every VC's there's a portfolio page, but everyone has their little bio page, and like, here's the investments that we did. From that, you can really quickly see, okay, there's some relevant stuff here. For someone who loves, like Kevin loves accounting technology and FinTech and worked into it. So I was like, this guy's awesome. I gotta get to know him. That's the kind of stuff that stuck out for us when we were doing our search.
So to recap this section, make sure you're solving a real pain point, being a painkiller, and also do your research as you're building your pitch. And you spoke about stages, and that's great because that actually leads into our next poll question here. We spoke about raising the basics, and now we are going to talk about if you are planning to raise capital, what stage are you at? So we want our audience to answer here. We have a lot of options because we understand that there are a broad range that you could be at. So in the poll window, I'll just suggest you scroll to the bottom if you're not raising capital, but you could be pre-seed, seed, all the series, or you could be planning on debt as well. I'll again leave this up for about 30 seconds. Seed plus was a new term for me, but that also makes sense. Like you're in seed, but not quite to Series A. Right. I'm going to end the poll, and looks like we have a lot of people actually in the seed and seed plus stage right now. We also have a Series C or later for the second highest and pre-seed. So that's helpful for us to know that there's a lot of early stage companies who are attending today. I am going to stop sharing and move to our next topic here, because I think something very interesting is going to come up, especially based on who is attending. Let's talk about the current trends of what's happening in the market right now. And for that, Kevin, I'm going to actually move to you, because there were some interesting slides we found, some interesting data, I should say. And what are we looking at here, and what should we make of it?
Well, Shreyas, actually, why don't we take the slides in reverse order to how we have them listed here, the Carta slides.
Okay.
This is information from Carta. They fairly recently launched an analytics group, and since they manage lots of private company cap tables, they have pretty comprehensive and interesting data across at least the US venture ecosystem. And one of the questions I think people are really most interested in understanding is what's going on in valuations. And in general, over the last 2 or 3 quarters, we have seen later stage valuations go, so call it Series C, Series D, and even Series B, decline more significantly from what were probably peak valuations in 2021. From an entrepreneur's perspective, capital at those stages has become a lot more expensive. From the investor's perspective, they might say that multiples and valuations are probably returning more towards really long run averages. And at the same time, though, I would say seed and Series A valuations have remained a little higher, closer to what were very, very high multiples relative to historical norms in 2021. And this is happening. This is the traditional pattern plays out again in venture, where private company valuations tend to follow recent tech IPO valuations with a lag, right? So think about the valuations. Think about a train that's either speeding up or slowing down. In this case, the train is slowing down. And if there's a little bit of play in the hitches between the boxcars as the locomotive slows down, the boxcars are kind of jamming up against it one by one. But it's the valuation impact will be felt first in the latest stage, just before IPO series, so Series D, Series E. And it takes a little bit of time for that process to work its way into early stage, so seed and Series A. Given that the impact on Series D and C has been so dramatic, some people are describing it as more bumper cars than train cars. It's pretty jolting. But in Q2, it looked like maybe for Series C and B that valuations are starting to stabilize. So, the cycle playing out all over again, impact felt first in late stage, slowly bumping the cars back through to earlier stage.
Yeah.
And if we flip back to that initial slide, this is a pretty interesting graph from my perspective. This is by quarter where the capital was invested that Cota had visibility into. And so in early 2021, lots of people were putting money into late stage. And you see that over, the subsequent 2.5 years, really the dollars in the venture ecosystem have shifted into earlier stage. That's good news for people that are thinking of, raising a Series A, a Series B. There's more capital available there now as a portion of the total investment dollars. But this is happening because a lot of investors are looking to manage, what I'll describe as financing risk. If you had let's say a 2020 fund and, you're trying to not have to go back out to market and raise your next venture fund until 2025, and you were doing big ticket Series C deals, well, maybe you're going to do some smaller Series A deals right now. You'll make that fund go farther. I think also the case where lots of investors, historically, when the markets get choppy, they shift to doing earlier stage deals because typically those are smaller companies, less headcount, smaller burn rates. And the investors, rightly or wrongly, take the point of view that it's going to be easier to keep funding that smaller burn rate until the market shifts in a different direction. So financing risk is really a key part of showing that you have manageable financing risk is a key thing that you need to do, I think, to raise capital today.
Thank you. Well, Martin, with what Kevin described and with all of these bumper cars we are seeing right now, what have you experienced work well for companies as they are trying to forecast, not just now, but actually for the past few years, that sales cycles are changing, there are supply chain issues and budgets are tighter. What have you seen work well for companies in this time?
Yeah, I mean, budgeting and forecasting has been around forever, but I think one thing that we noticed, like March of 2020, when COVID started, every company in the world was forced to reforecast their budget. There's like not a single person who kept their budget at that time. And I think the people who succeeded and grew a lot through that became really agile in their forecasting process. So it, instead of the budget being this thing that your boss or your board told you to do once a year because it's in your investor rights agreement, it became this strategic tool that the team was looking at and using as a living document. And that became, the folks who really, weaponized this budgeting. They've basically created an agile process where they're rolling this forward, at least every quarter. And some companies even do it every month. And those are the ones that are able to kind of navigate, because it's never a straight path for whatever your plan is. Everyone's model and plan will always be different than what actually occurs. But if you can make the zigs and zags not be as jarring and not so big, and you can redirect every quarter, every month or so, that's how you don't veer too far off, and you can figure out what you're doing there. And this goes into rolling forward your revenue forecast, your rolling forward your headcount plan. Even though you plan to hire all these heads in 2 quarters out from now, look at your numbers at the end of the quarter and go, did we hit our number or not? Because maybe if sales was 5% too low, that actually, if you're like a SaaS business, that compounds over time, can screw up your cash plan, if you keep on hiring at the same rate. Watching for these things, rolling it forward at, as quickly and as often as you can. That's what we've seen to be a big predictor of success.
Right. Kevin, what have you seen similar, lot of pivots, right, is what Martin described. How have you seen companies successfully make those pivots, either by necessity or because they were ready for it?
Great question, Shreyas. And we've seen, through, I'd say, the last 3 or 4 years, not just with the shifting valuation landscape, but with COVID. that for some companies in our portfolio drove supply chain disruptions. Things went on where that replanning or that weaponization of planning, I loved when Martin used that phrase, became critical to those companies surviving. They had to be very agile. And I can think of a couple of examples. One was a hardware company in the Cota portfolio, in one of the other funds, not my fund. They had demand for, say, 2,500 units of their product in a given quarter, but because of supply chain disruptions and things going on in the semiconductor industry, well, they were on allocation. They could get 800 parts. And they had to reforecast literally every couple of weeks. And so having the team and the systems in place that let you do that let you react quickly, I think are how you as a company can be nimble, and you can make, sometimes they're hard decisions, but they're essential decisions you need to manage your cash. We had another company whose primary customer set were regional banks. And they had a great year last year. And boy, guess what? SVB imploded in March. And for 2 quarters, their customer set froze up. We can all go look at the news of, every regional bank in America was busy saving capital and shoring up their balance sheet for the last few quarters. It's changing in the last few weeks. But that was another company that had to really react quickly and leverage that agile, nimble planning process and a lot of work on the part of the senior team to react and adjust their operations. And the faster you react, the more of the cash that you have you can preserve, the more runway you have to continue to grow and still achieve the milestones you need to achieve to raise your next round.
Thank you. I'm glad you brought up Silicon Valley Bank, that collapse. I'd read what they funded 60% of their 60% market share of venture debt. How did that big event affect capital raising, if at all?
Well, from our portfolio's perspective, it's become a lot bigger of an effort, a lot more homework and research involved to raise debt today. And, absolutely, SVB was probably 60% or more of the market in providing venture debt before the implosion. In some cases, they relied on relationships with your investors, and they would do light diligence and trust that the investors would take care of them as the company navigated its course. And that market has completely changed. Today, there's a much bigger set of smaller investors, many of whom have stepped up and are more active. But where SVB had a very big box and there were lots of stages and types of companies SVB was willing to underwrite with debt, these new players and emerging players in the market have much smaller boxes. Some of them only like certain types of companies. Others are very focused on specific stages or sometimes both. And so I think, if research was important in doing your homework and raising equity, it's probably 3 times more important today in finding the debt providers that are really interested and understand the type of company that you are. I think beyond that, they're looking for much more reporting than probably was the case 2 years ago, a year ago. 2 or 3 levels more deeply, and not just debt providers, but equity providers today now as well. In addition to wanting to know your CAC and kind of looking at your lifetime value of a customer versus your CAC, we're all looking at probably 3 or 4 levels deeper of that. In terms of what's your CAC payback? Well, what's it cost when you add a rep or a BDR? Are you adding them in what sort of increments? And really trying to get a sense of what flexibility the management team has in growing or managing the business. And I think strong reporting and agile forecasting are kind of a key part of showing that you have what it takes to earn the trust of the debt or equity provider today.
And
Yeah.
Go ahead, sorry, Martin.
Yeah, and then I've noticed this also affecting not just like the tech ecosystem too. We're all trying to get equity and debt on that side, but even like for Main Street, when you're getting debt, there's obviously interest rates, and you hear about interest rates going up for and most of us probably think about our mortgage and are like, oh crap, we can only, we can't get as expensive a house that we could have had, a year or two ago. But the same thing gets impacted to businesses, and who are trying to get, SBA loans. The interest rate for an SBA loan is like double what it was 2 years ago, which then means you have less capital to be able to put into your business that you're working, because you're paying it with more of the debt. So your cost of capital is much higher, which just means, it's making it that much harder to be able to grow, and it's costing everyone a lot more, across the entire economy.
Martin, I think that's a great point and spot on. The analysts that watch the Federal Reserve are saying higher for longer now. So, interest rates probably stay elevated for the next year, if not longer. And beyond that, the regional banks that make a lot of the loans to Main Street, many of them are also the lenders that own a lot of commercial real estate today. And that's a market where, there's lots of write-downs and write-offs expected to come. And that pain in part of their lending portfolio is going to keep rates elevated in the rest of the business portfolio. So agreed that being on your game is important, whether you're raising debt or equity or you're Sand Hill Road or Main Street.
So real quick, Kevin, so would you say they are more cognizant about the financing risk, given all of these situations, what is going on?
I think every investor or lender is much more focused on financing risk today, than they were 2 years ago. Certainly within the venture ecosystem, 2 or 3 years ago, industry analysts and the trade journals would talk about fear of missing out. People were rushing quickly to get into what they thought were the hot up into the right deals. Today, people are investing at a slower pace. They're doing a lot more homework on every individual deal. How investors think about, what is financing risk? How do I manage it? How do I check it out? I think is different by investor. But I think the more experienced and the better investors are really looking at things like, all right, within this investor syndicate that I'm joining, we've got new investors joining this round. There's existing investors around the table. Do we have enough capital to help this company get to break even? That's really, I think, kind of the key question that we're all trying to sort out. And if we do, then that's lower financing risk. But it's there's lots of pieces and inputs that go into that equation. Reserve allocations might change within that investor group. Part of how you answer that question is really the fundamental nature of the business that you're investing in. If it has to hold expenses, flat or moderate the growth in the expense line, can we still grow revenues? That's why it's important, I think, to be mission critical or the painkiller versus the vitamin. And then, as we've talked about, I anticipate that we're going to see more whipsaw events in our global economy, right? We've got wars going on around the world. We've just lived through COVID, but if there is a disruption, how quickly can this management team react? Those are all inputs that we're thinking about in terms of thinking about how do we define and measure and want to mitigate financing risk. And certainly investing in a great management team, but also a team that really has great tools that let them weaponize planning and reporting, that let them really stay on top of the business and manage every penny that they're spending. That's really important to us today as we think about where we want to put our capital.
Right. So agility is expected, not just a good
agility is an essential, thing that you've got to show now. It's not a nice to have, it's a must have.
Well, that leads up to our next poll here, which is going to be around thinking of agility. You as a company audience, if your board asked you to reduce your burn rate by 20%, how quickly could you reforecast and share your plan? We are trying to think right now. We just heard about the importance of agility. I'll launch the poll and again, give everyone about 30 seconds to answer that. I know there's certain companies just reading that question will stress you out, but just it could be a very real situation as well. Okay. Few more seconds. And right, I am going to end the poll and share the results. So, well, there must be a lot of Jirav customers here because 37% say they could do it within days. There are also the largest percentage would take 1 to 2 weeks to do this. And then there are others who understandably might take longer. Every company is at a different stage. So, there's no right or wrong answer. It's just you assessing where you are. All right, I'll stop sharing there. And then we are now going to move into our last section here, which, given what we've heard about what's going on, what's in the mind of investors and lenders, how do you as a company demonstrate that financial health and stand out and be a good candidate for funding? Sorry, just quickly jump to the takeaways. I'm going to go back to our panelists here and first actually ask Martin, what do you think about the poll results we saw right now?
Yeah, I mean, I think it's interesting, as you mentioned. I hope that all the ones that are doing a couple days are Jirav customers on there, and but it's exciting to see, and I think people are making it a priority to be able to do this stuff fast.
Yeah. I mean, what a time to run a business, right? So I think the next question I had for you, Martin, was, given that what we have heard, what can a CEO running a company or a CFO do to show less financing risk to investors, as Kevin mentioned?
Yeah, I think the big ones are always kind of maintaining, obviously you have your financial model, you have your plan, but also make sure you have kind of, there can be an upside plan, but have a downside plan and be able to kind of understand that you can stress test this stuff. What will happen if sales is 20% less or even 50% less? And what's your zero cash date? And always know this number. That should be something that every single person on your leadership team should know. I think that's a key one, because that goes back to that financing risk. And if you have that date, do you have enough access to capital? And time's the most valuable thing that you could potentially have. Beyond that, I think being able to tell a really great financial story is the second one. So obviously knowing where you're at, but where you're going. And this is key. I think a lot of people, tend to short sell themselves on stuff, but when you're a painkiller, everyone here is building amazing, cool businesses. Show why this thing can be successful. Show the ROI of your business that you're doing. And show how you're operating it efficiently. So, are you spending, the appropriate amounts on sales and marketing relative to your growth? And if not, right size that quickly. Don't let it just burn and fritter away all your cash. The other ones I think are, when you do this and you share this model out, try to make it not just be something that's sitting in the CEO and the CFO's inbox or on their desktop or whatever. Have it be something that your leadership team knows. Like we at Jirav, we've shared our financials and we say to our team, high level, here's what we're trying to accomplish and where our levers are, and we value transparency. And with that, that helps drive accountability for your teams. That's another key one. And when everyone's accountable and you're all marching towards the same goals there, it makes it a lot more achievable. And then lastly, I think that agility, the speed and confidence in the planning. If you're refreshing this every quarter at least, there's less stuff to corral for the differences, which can then make that reforecast very quick. And it's like building this heartbeat in your business. And when you're operating in a heartbeat, it's just, there's a rhythm that will start going, and it doesn't become this scramble to do that.
Thank you, Martin. Kevin, as being on different boards, what are some war stories, or what are the ranges you've seen when it comes to you asking that question of companies?
Well, I think my advice and my war stories would really back up what Martin was, the advice he was giving to the audience. I think one, for example, real world situation the CEO often ends up in is you have board members with different points of view, and sometimes big ego board members with different points of view. But having great reporting and a great tool to run different scenarios, I think can be a really effective tool for kind of cutting through this board level conflict faster, which is really what you need to do as the leader of the company to make the decision and find the right direction and go. Companies that can't pull together the metrics and can't do reporting have a much harder time in making those decisions. It takes longer. And while your board argues and the CEO maybe is working things in the background, precious cash is burning away. I think another real world example is companies that are more organized, that have better reporting and that have a better process are really going to be the ones, as I think about our partner meetings where we're prioritizing for different funds, where we're going to allocate our capital. Oftentimes, if there's companies with equal prospects, the one that has that better reporting and the more agile process might be the one that is going to merit the follow-on financing. We really like and respect the fact that they're able to react. We think that just reduces the risk and gives that company a higher probability of going on to greatness. And I'd urge people, I'm picturing a particular company where we had a fractional CFO. We had, one that was spread very thin, one that wasn't happy about, what he was being paid by our portfolio company. And in 9 months, I think we had 8 board meetings where we had financials with errors, inaccuracies and things that were just really slowing down and making the board meetings take longer. The board members were projecting the reporting in spreadsheets and doing voiceovers of, well, just add $25,000 to this line and subtract 50 from that. It was a nightmare. We ended up having to take some pretty hard action with that company, and we had to replace the fractional CFO. So being efficient, being accurate, having great reporting, showing your board and investors that you're really on top of what's happening in your business, I think it's best way really to run the business. And it's a great way to make sure that you attract more capital.
Thank you. We are getting towards the end of our webinar here. And so I wanted to quickly run through the key takeaways of what we've been hearing. The conversation was really pretty interactive, but I think we did hit some of these takeaways that, number one, show you're solving a real pain point and do your research as a company when you're going out seeking capital. Number two, investors and lenders are really risk sensitive right now, and they are diving in many levels deeper to look at metrics. So solid reporting is going to help you stand out. And finally, that agility in planning is universally expected, no matter the industry or size of company you are in. And good data and reacting quickly to that good data is going to help you stand out. We had a couple of questions come up during the session, so I'm going to bring those up right now. I think one of the questions we had, Martin, was for you. It was, once you recognize you're not talking to the right person as you are going for investors, how do you leverage the person you are talking to in order to connect with the right person? How do you do that without coming across as rude?
Yeah, like one of the ones, like the real nice way I position it, I go, is there anyone else at your firm who you think would be really excited about what we're doing? And right away, people go, oh, Jane or Joe or whatever. And it's like, it's a super easy way. Also, a lot of times I do that because when you go through the fundraising process, first you meet, maybe you go through an associate, then a VP, then a partner. And then, things get serious when people bring in 2 partners, because then they're going through. So that's like a really elegant and nice way to get that second partner involved. And, and if this person is, at all thinks that there's a fit, they'll tee you up to the right person that way.
Great. And another comment was from Andrew around, I think, the story about the board I hate to hear that since I'm a fractional CFO. And to that, I'll say, Andrew, it's not the fractional CFO role. We have a lot of fractional CFOs who love Jirav and use Jirav. It's the fact that this specific CFO was taking so long to, get the answers that they needed to.
I'd say it's also more a comment on spreadsheet-based forecasting and budgeting, where one bad input can just sort of ripple through a bunch of linked Google Sheets, and then the last thing in the world anybody wants to be doing is error checking real time in front of the board, because it will never work. That experience, honestly, was one of the things that really convinced me the utility of a really strong framework with process and data control like Jirav. I think there's big value in that.
Yeah, great. Well, thank you everyone for your time today. I see we are at time. I wanted to end with a quick few resources. We are getting into annual planning season, and Jirav has an annual planning guide for you, which will help you through the process. We also have our next webinar on September 21st, which will be focused on annual planning best practices with Jirav experts, a customer, and the guys from FP&A. And then finally, if you are a new customer and looking to set up your annual budget for 2024, mention this webinar to our representatives, and you'll receive complimentary expert consulting to set up your annual budget. With that, thank you, everyone. This was a great discussion, and you'll get a recording of this later. All right, bye.